Hi guys, and welcome to the channel. Today I'll be going over the 6 categories that Peter Lynch talks about in his One Up on Wall Street book, which is an absolute classic book in investing. I first read this book a few years ago and I recently read it again a few weeks ago. I have applied most of the stuff he talks about in the book into my own personal investing, so I feel like I have a solid enough grasp on the book to make a video on it and teach people the concepts in this book. So we are going to start off with the first stock category, which is the slow grower. Now, slow growers are very well established companies growing at 1 to 4% a year, just right at the pace of the US GDP. Modern day examples would be Triple M, IBM, and Coca-Cola. Now, Peter Lynch is not really a fan of slow growers. He says the only reason to ever buy them would be for their dividends. But since their earnings aren't growing much at all, neither will their stock prices. Therefore, you want to ensure that the dividend payment for these companies have always been paid out on time and that they have consistently been able to raise their dividends over the years. Additionally, you should also check to see what percentage of the earnings are being paid out as dividends. If it's a low percentage, then the company has a cushion in hard times. It can earn less money and still retain the dividend. If it's a high percentage, then the dividend is much riskier. So next up we have stalwarts. These are big companies that, unlike the slow growers, are still growing faster than the US GDP and aren't likely to go out of business either. So modern day examples of stalwarts include McDonald's, Costco, Lockheed Martin, and United Health. The key issue with these stalwarts is that you have to get a good price. You can do this by using the PE and PEG ratios to tell whether you're buying stock when it's undervalued or fairly valued. Now, these stalwarts can be very good holds and can make you a lot of money in the long term. So many people buy these stocks to hold forever. In fact, Peter Lynch published this book back in 1989 and gave McDonald's as an example of a stalwart to hold forever. If we take a look at McDonald's return since 1989, you can see for yourself that deciding to buy McDonald's and hold it forever would have been a very good decision. In fact, McDonald's has an average compounded annual growth rate of 12.25% since 1989, compared to 8.57% for the S&P 500. In other words, if you followed Lynch's advice and invested $1,000 with McDonald's in 1989, you would have over $36,000 today, compared to only having $13,700 had you invested in the general S&P 500 index instead. Until this day, McDonald's is still going strong as a stalwart. Next, we have the cyclicals. These include car manufacturers like General Motors, oil companies like ExxonMobil, and banks like JP Morgan or Bank of America. Cyclicals, like their name suggests, are cyclical. This traditionally means that they outperform when the economy is good and underperform when it is not. Tips Peter Lynch gives on managing cyclical stocks is that 1. People will also be anticipating the end of the cycle. So despite earnings increasing, the prices may actually stagnate. So the PE may begin to shrink early even before earnings start declining, as investors anticipate that earnings will peak soon. And this means that it goes without saying that these are not stocks that you want to hold forever. These stocks are more suited for you to buy low and take profit high at. Secondly, is that in many cases, the worse the slump of whatever cyclical industry the stock is in, the better the recovery, because stocks become more undervalued and they have more room to bounce back. Next up, we have the fast growers. Like their name suggests, these companies grow fast. Examples of modern day growth companies include Facebook, Salesforce, Amazon, and Nvidia. Now, these companies have projected future growth rates around 15 to 30%. Sometimes you have to be wary of those higher than that, as that usually means they're in a hot industry. A growth rate of 40% or more should also be seen with skepticism. Now, when evaluating these growth companies, make sure that the company has a track record of success and that it actually still has more room to grow its earnings. For example, using a restaurant chain, if a restaurant is only in a few states, it has the rest of the US to go. If it's already in 49 states, its growth is very limited. Also, try to ensure that you are getting a good deal. To do this, you should use the PEG ratio, which is the current PE divided by the past 5 years earnings growth or the next 3 to 5 years earnings growth. So the PG ratio should come out to be around 1 to 1.5. Finally, this may not be applicable to the large cap stocks I mentioned as examples of growth companies earlier, but this detail is incredibly important if you are scouting for up and coming growth companies where you can make huge returns, such as 5 baggers, 10 baggers, or 20 baggers, which is what Peter Lynch calls making 20 times your investment. Lynch recommends you take a look at growth companies who have very, very low institutional ownerships. If few institutions own the stock and barely any analysts have ever looked at it, then it's great because once the institutions come and they start pouring their money in, your $4.56 stock will start zooming up, and all of a sudden you have a 20 bagger on your hands. Next up, we have turnarounds. Peter Lynch says turnarounds are companies who have fallen from their previous highs due to some unfortunate factors. A modern day example of this would be Boeing, who fell from its high of $446 down to $85. Now, an example that Peter Lynch gives in the book is Apple, who in the 80s had fallen from $60 to $15. Now, here's a quote from the book. After Apple computer fell apart and the stock dropped from $60 to $15, I wondered if the company would ever recover from its difficulties and whether I should consider it as a turnaround. Apple's new Lisa, its entry into the lucrative business market, had been a total failure. But when my wife told me that she and the children needed a second Apple for the house, and when the Fidelity systems manager told me that Fidelity was buying 60 new Macintoshes at once, then I just learned that A, Apple was still popular in the home market, and B, it was making new inroads in the business market. I bought 1 million shares and I haven't regretted it. Lynch didn't regret buying Apple back then as its stock had already recovered by the time the book was published in 1989. But unless you have been living under a rock, you would know that the investment into Apple would pan out incredibly well over the long run, as every $1 invested into Apple back then has yielded $400 over the last 31 years. That's a 400 bagger. And just so you know, Lynch retired in 1990, but if he had kept managing the fund and kept those Apple shares, that 1 million shares he bought, which would have been worth about 15 million back then, would be worth over $6 billion today. Another note is that once a turnaround has rebounded, it is no longer a turnaround. Therefore, you want to class it into one of the other categories. If it does not fit into any of these other categories, you should sell the stock and reinvest the money into something else. If you specialize in turnarounds, you might as well not even bother reclassifying it and just sell it and use the money on a different turnaround. Next, we have asset plays. This is when the market has missed out on something valuable that a company owns. When you are looking for an asset play, you have to ask yourself the following questions. Number 1, what is the value of the assets, and are there any hidden assets? Assets can come in the form of land, cash, patents, and even losses that can carry over as tax write-offs. Next, the second question you want to ask is, how much debt is there to detract from these assets? Remember that creditors are first in line to get the money, so you've got to check, how much debt does the company have? Additionally, you also want to check, is the company taking on any new debt? Because that will make the current assets of the company less valuable. Third, you want to see, is there a radar in the wings? Make sure to look if there is, because these will be the ones helping you reap the benefit of the company's assets. So that marks the end of the video. I hope you took notes because that was pretty quick. So if you didn't, make sure to go back and rewatch the parts you didn't quite grasp if you need to. Additionally, I highly recommend that you watch the Swedish Investors One Up on Wall Street summary of Peter Lynch's book. This is a great video and a great channel. He doesn't really go into as much depth as I did on each single stock category, but he does convey a lot of the important elements of Peter Lynch's book in just 15 minutes. So I highly recommend watching that. Additionally, I also recommend actually reading the book for yourself. While the Swedish Investor's 15-minute summary is good, it is by no means capable of conveying all of Peter Lynch's knowledge as well as the book actually can. So if you have the time, grab the book and read it. It is advice from one of the greatest hedge fund managers of all time, so you'll definitely be getting your money's worth. So that's it, guys. If you stuck around, give the video a like if you liked it, a dislike if you disliked it, and comment down below any questions. I will respond to all of them. Also subscribe, because I will be making more videos covering the topics of this book in detail as well, so stick around for that.